Thank you, Ali. My name is John Mullins, and I'm a portfolio manager at Lyrical Asset Management, and I'm a lead PM on the Curate Global Value Equity Fund. And today, I want to talk to you about boring things, because boring investments, we've found, are a good way to make a lot of money. Now, in today's market, most people are obsessed with exciting AI-related stocks. But we think some of the most attractive returns to be found in the market are hiding out in some of its most boring places. Over the next 15 minutes, I'll show you why we love some boring businesses, distributors, the middlemen of the global economy. Everyone wants to talk about the exciting stocks in the market, and today nothing is more exciting than AI. At times, it can feel as if the entire market has been split into AI winners and AI losers. And we see that here on this slide. On the left side, you can see the semiconductor index, which is the poster child for AI beneficiaries. That's up 89% year to date, while software companies, which are considered to be AI losers, are down 14%. Now, both of these groups are exciting, and having a view on them can make you popular at the next cocktail party you attend. But can you effectively bet on either of them? Let's look at semis. There's a lot of AI-driven growth in semis to get excited about. But as we see on the right side of this slide, they trade expensively at 28 times forward earnings. And then there's the other problem with semiconductors, which is that because of supply shortages, their margins are much higher today than they have been historically. So it's easy to see a version of the world where betting on semis from here is a great bet. But it's also easy to see a world in which those margins revert back to normal levels and multiples collapse. What about software? Well, in the software sector, we have some companies that have previously been considered some of the best companies to ever have existed in the world. And now some of them are on sale, having gone down this year. But as you can see on the right side, these companies are still not cheap. They trade more expensively overall than the market. And can you really figure out what the future of software is in an AI world? If you think about what we do, investing, as playing a game, we would say that investing in AI winners or in AI losers today is a hard game to win. After all, most investors in the world are digging in on just these topics and placing their bets on these exciting areas in the market. And a game that has more players is harder to win. In the Curate Global Value Equity Fund, we prefer to play games that are easy to win. And to do so, we focus on areas of the market where others ignore it, where there are fewer players to compete against this. As an example of this, in our fund, we own distribution companies. And if we look at this slide now, we've added a new line. In green, we add the distribution stocks that we own in the Curate fund. These stocks make up about 10% of the portfolio. Now, perhaps surprisingly, these stocks, which are quite boring, are doing quite well this year. They're up 41% year to date, or more than 4 times the return of the MSCI World. But as we can see on the right side of this slide, these companies are very cheap at 14.5 times forward earnings. If we consider this a game, the price to entry here, the price of admission to play this one, is much lower than investing in semiconductors or in software stocks. These stocks trade at a 25% discount to the market and a 50% discount to the semiconductor index. And that's the message today. Boring businesses and easy games, they can deliver exciting returns. So what are these boring stocks? They're distributors, the middlemen of the global economy. They each work with thousands of manufacturers to buy and then deliver their product to hundreds of thousands of customers. And on each side, they add significant value. For manufacturers, our distributors act as an outsourced sales force and marketing arm. Consider, for example, Rexel, which we own in France. This is an electrical distribution company. And they help small electricians buy the products that they need to do their work every day. So a small electrician will show up at a Rexel branch and buy the switches that they need from Schneider on their way to work. Schneider doesn't want to own that relationship with that customer, and they certainly don't want to have to get in a van and drive to that customer's work site hours later when that customer needs a refill in product. On the customer side, distributors also add a significant amount of value, this time by getting them better prices and delivering to them much better service. Consider, for example, the case of Brenntag, a chemical distributor. If you were an owner of a craft brewer that needed to have food grade acid to clean out your tanks in between brewing different batches of beer, you wouldn't be able to call up Dow Chemical and get that chemical that you need in order to do the work. So you call Brenntag instead. Brenntag can use their massive scale to get that product to you for a much cheaper price. And instead of delivering it to you in a full rail car's worth of it, they can bring it to you in a small container just in time for when you need it. In total, as you see on this slide, we own 6 of the world's best distributors. And we think owning these distributors is akin to playing an easy game. Each is the number 1 or number 2 player in their niche, and they earn high returns on capital because they have a significant scale. They're highly resilient, and we don't think that you need to have a view on AI to make investments in any of these companies. But before we go too deeply into these stocks, let's take a step back. Because one of the most exciting things we find in these boring businesses is their valuation. They trade very cheaply relative to the market. But why does that matter? Well, it matters very much for what you see on this slide. Cheap stocks deliver excellent returns over time. What we're seeing here is that the cheapest 20% of companies have outperformed global markets by more than 5% per year going back to the 70s. Value is the most enduring source of alpha in markets. And that is why when we purchase stocks in our fund, we only select them from amongst the cheapest 20% of stocks in the world. But there's one really important distinction to make here, which is that top line, these companies that have delivered exceptional returns over time, they've done so in spite of the fundamentals. Value works on average because nobody wants to own a bad business. The stocks in that top line, on average, they've undergrown the market by 2 to 3% per year on an earnings basis. They have worse balance sheets, worse returns on capital, worse management teams. Nobody wants to own a bad business, so those stocks become too cheap and then they re-rate later on. That's why value works on average. In our fund, we try to do something differently. We believe that hiding out in that top line are some pretty good companies. And if we're diligent, we believe that we can find them. How do we do that? Well, as you can see here, we follow a disciplined investment process. We call it value, quality, and analyzability, or VQA. On the left, value, that's pretty obvious. As I said already, we only buy stocks from amongst the cheapest ones in the market. But what about quality and analyzability? Well, quality for us means we want to buy reasonably good businesses. We don't think we'll ever own the best companies in the world, but that's okay. We want to own businesses that can sustainably generate double-digit returns on capital by having a real and sustainable economic moat around their business that can allow them to reinvest at those higher rates of returns and drive good earnings growth. We also look for analyzability. What that means is keep it simple. In other words, play games that are easy to win. We value businesses based on their long-term earnings power. If we can't tell you reasonably what that is, the game for us is too hard to play. We'll look for something else. Now, as you'll see now, the distributors that we've talked about clear all 3 hurdles quite clearly. Let's start with quality. Do our distributors have the quality that we look for when it comes to VQA? Well, we think so. Just look at the top left on this slide here. Our 6 distributors have earned 20% returns on capital for a decade. And what's really interesting is if you look at the bottom left, they earn such great returns while using very little capital in total. Their CapEx to revenue is less than 1%, which compares to the MSCI world at about 5%. And the reason that they can generate these returns is very simple. It's scale. Because they sit between thousands of manufacturers and hundreds of thousands of customers, they're able to negotiate with those manufacturers and drive prices down. And that allows them to generate those returns quite a bit above smaller players very, very consistently. And now, importantly, this is a moat, this scale-driven moat. It shouldn't be impacted by AI in any type of negative way. A smaller distributor can't use AI to all of a sudden gain the scale that they need to compete with a Rexel or with a Brenntag. In fact, we think AI will likely be a beneficiary of these companies because with their scale and with their balance sheets and with their cash flow, they're actually able to invest in AI and give them more of an advantage relative to their smaller peers. Now, one thing I will point out on this slide is if we look at the bottom right, leverage is one of the key components we think about when we think about owning quality companies. And our distributors have more leverage than the average company in the market at about 2.4 times net debt to EBITDA relative to the MSCI world at 1.3 turns. But we're very comfortable with that level of leverage. And the reason is what we'll see on the next slide, which is that these companies are incredibly resilient. As we see here, this is the magic of distribution companies, and it's what makes them so analyzable. Counter-cyclical cash flows. We saw before how these businesses are very capital light. Well, distribution companies, the biggest asset that they have on their balance sheet is inventory. Because what they do is they buy product from a manufacturer and they hold that inventory typically for about 2 months before selling it on to the end customer. Now, this is very important because what happens at a distribution company is when sales slow down, like in a recession, as we see here, the company stops buying new inventory and they run down their current inventory balance. And what that means is as sales slow down, free cash flows actually go up. Consider this on the left side of this slide. Our distribution companies, their free cash flows in the global financial crisis went up by about 40%, while cash flows for the overall market fell precipitously. This makes these companies incredibly resilient because they are bulletproof in recessions. Rather than be worried about them when a recession comes, we're actually excited about them because they're generating more and more cash. And that can allow them to play offense in a challenging period. For example, they can take that excess free cash flow and they can go and they can buy smaller companies and actually add to their moat that is scale driven. Now, this is something that might sound boring to others, but to us is incredibly exciting. And as we move on to the next slide here, we can see that putting it all together, value, quality, and analyzability gives you something that's very uncommon, which is a combination of value and growth. Here we see 3 charts. At the top is the total return, in the middle is the earnings per share, and at the bottom we have the valuations or the PE multiples. Here we compare our 6 distribution companies versus the growthiest index in the world, the S&P 500. As you can see in the middle, our distribution companies have compounded their earnings at an 8.9% rate going back to 2007. That's faster than the S&P 500's growth at 7.1%. And yet, these companies trade today for only 14.7 times earnings, as we've discussed, versus 21.5 for the S&P 500. That's a third of a discount for companies that are actually growing faster than the market. Now let's dig in a bit more to 2 of our distributors. They may both be boring, but one of them does have an exciting AI-related story. The other one is just boring. Not only is it a boring distribution company, but they serve a very boring end market, which is the dental market. First up here we see TD SYNNEX, a leading global IT distributor. They act as a middleman connecting hundreds of tech vendors to 150,000 or so tech resellers across 100 countries. For tech vendors, they're an outsourced sales force, a way to connect with so many resellers. And for customers, not only do they provide the best price, they also offer things like financing and service. They can help you actually install these technology products and manage them. So how does it look on VQA? Well, let's start with valuation. As we can see here, this is a pretty growthy company. TD SYNNEX has grown its earnings at a near 16% rate going back to 2007. That's more than double the S&P 500 growth over that same period of time. What about the valuation? Well, it trades for only 14.7 times earnings, a significant discount to the market for double the growth. But what about quality and analyzability? Let's start with quality on the left. We see that returns on capital for TD SYNNEX have grown from an already high 20% to nearly 30% over time. And that comes as the business builds more and more scale. It's widening its moat over time. But what about analyzability? Can we predict it? Well, we think we can. Look at the right side of this slide, which shows 2 decades of steady growth in revenue per share and margins that have been very steady, including through recessions. Now, one thing I'll point out here when it comes to analyzability for a tech distributor is one key risk would be obsolescence, because what TD SYNNEX is doing is they're acquiring technology inventory and they sit with it for a little bit before they sell it on. And so obviously they could be at risk if these technology products become obsolete, if there's a newer thing that comes into the market. But in this case, we're actually protected. And the reason for that is that on the vast majority of its inventory, TD SYNNEX has either price guarantees or return rights on that inventory, which really means, interestingly, the biggest asset that TD SYNNEX has is its inventory, and most of that inventory doesn't really carry risk to TD SYNNEX. The risk remains with the vendor, which also just goes to show you how powerful the business is in its ecosystem. Now, I mentioned this is a company that has some excitement to it. There is an AI kicker here. It's called Hive. About 30% of TD SYNNEX's business it provides distribution and design to data centers that are being built out by hyperscalers. This is a fast-growing part of the business, and it is quite exciting. But the main thing I would point out from our point of view is that you don't have to pay for that excitement when you're trading a mid-teens PE multiple for a stock. And so as excited as we are about the data center distribution business, we don't think that you need to have continued outsized growth to get excited about this stock. Now, finally, let's talk the most boring of the boring, the dental market and Henry Schein. Henry Schein is the #1 dental distribution company in the world with a 40% market share in the US. 90% of dental practices in the US are a customer of Schein for something. If a dentist's chair breaks, typically that dentist is calling Schein and they will be there that day to fix it. And Schein does more than just provide products. They're the largest provider of software into the dental industry. And so it's likely that your dentist is actually using Schein software to put in an insurance claim or to manage your appointments. It makes them truly a very sticky business. As you can see on this slide, it's a company that's outgrown the S&P 500 going back to 2007 with 8.9% earnings growth per year. Not only has it grown faster than the S&P 500, it's very recession resistant, and revenue grew right through 2009. How does it look on valuation? Well, only 13.7 times earnings for a high single-digit earnings grower. That looks pretty exciting to us. Now, Schein also is a high-quality business, and we see that here on the left with 20% returns on capital. It is the dominant scale player, and that allows Henry Schein to earn margins that are about 50% higher than the next largest player, which just goes to show you how important having that scale negotiating leverage really is. And as for analyzability, as we see on the right, this is a company that for 2 decades has delivered a steady 5% revenue growth with margins very steady over time. This may be a boring business, but it's one also that has non-deferrable revenue. Even in a recession, if you need a cavity filled, you typically get that done pretty quickly. And that allows Schein to grow revenues, as we see here, through recessions. Now, Shine may be a boring business to many others, but to us, having a 9% earnings grower that's recession resistant, that's quite exciting as far as we're concerned. As we come to a close, from Shine to Cinex, we've seen how boring companies can deliver exciting returns. We'll leave the exciting stocks and the harder games to everyone else. We'll stick to the boring companies and the easy games, all in an effort to deliver exceptional returns to our investors. Thank you very much.
Thank you, John. What stands out about Lyrical's VQA approach is the belief that the strongest performers over time are not the most exciting or headline-grabbing businesses. As you heard, Lyrical's philosophy offers an interesting contrast to the views shared by Jennison earlier. While markets today are heavily focused on AI and high growth opportunities, Lyrical reminds us that attractive long-term returns can also be found in businesses that are often overlooked. The discussion highlighted that valuation matters, and that buying high-quality businesses at attractive prices remains a powerful driver of long-term investment success. To summarize, the Curate Global Value Equity Fund, the portfolio aims to deliver long-term capital growth by investing in companies that are undervalued relative to their true worth. This approach provides a strong complement to growth and quality strategies, helping investors achieve a more balanced and diversified outcome.